welcome to this special edition of ED Interview. There's a lot of uncertainty in the market, so we thought who better to make sense of it all but veteran investor Ramesh Damani, who's my special guest on the show today. Ramesh, it's so good to have you on the show. Thanks very much for taking out the time.
Thank you, Tanveer. Always a pleasure.
Great. Ramesh, let's start talking about the global macro risks that are there in the market right now. You've been bullish on the market. So what perspective can you offer when you hear prominent market voices like Mark Farber talk about a possible global recession come 2013?
Well, anything Mark says I listen to very carefully because he's he's a very good historian of the market, a deep understanding of markets. But this is the way I view it, Tanveer, and markets always pay you for your independent view. Markets are climbing the typical wall of worry, whether it's in America or whether it's in Europe or whether it's in India. And a couple of dates that are very important for the investors. The most important is, I think, September 6th or 7th, when Mario Draghi lays out the ECB policy regarding the Eurozone. I think the market is in a hold mode until that particular date. But I think on that date, if Mario delivers, I think the second part of this move that we're seeing up for the last 3 months will probably resume. And I'm hopeful, looking at the tea leaves, reading what he has to say, that he will deliver something that will be adequate for financial markets. The only problem is Greece. And Greece, you're right, the tombstone is laid out for Greece, the casket is laid out, walk in there and get out of the Eurozone, death all over. But I don't even think the Greek people want to get out of that. I think they're going to have a huge fight before they get out of that. So I think to call the EU dead or the Euro dead is perhaps, in my view, a bit premature. I think there's a saying that I learned when I was an economics student in America, that you don't fight the Federal Reserve. What that means is you don't fight the central bank. Central banks have a lot of armory in terms of liquidity, in terms of market job owning, in terms of policy moves available to them. I think Mario Draghi is going to unveil some of them on September 6th, 7th. So at least I would not be on the short side of the market ahead of that date. Other than that, market is going in skeptical, and we'll just see how we'll take it from there.
But what do you think can come out? I mean, at the end of the day, there's been only more quantitative easing from both central banks, right? And that's something that the market has almost gotten used to.
I don't expect anything dramatic from the U.S. central bank. The Fed Jackson Hole speech, I think in 2010, led to a lot of liquidity in the market. I don't expect anything similar to take place. More noise, more confusion, more preamble. But it's an election year in the United States. I don't think there's going to be anything dramatically wrong. Liquidity will remain strong in the U.S. till the election year, which is in November, take place. But in Europe, liquidity solves a lot of problems. It glosses over a lot of problems. Maybe it's not the ideal solution, but it's a solution that the market wants right now. It's parched for liquidity, not for liquidity, but for easy solutions. And I think Mr. Draghi will provide that. What he will try and do, from what we understand, what he'll try and do is almost, instead of having limited bond buyback programs, $100 billion, $200 billion, say there's almost unlimited amount of money we'll use to buy back bonds, but at a targeted rate where the yield should be. So in effect, he will give Spain and Italy chance to sort out their problems by keeping the yield on their bonds fairly low. Over time, they will also signal a message that the euro needs to be more integrated economically. So more budget-making powers move to Brussels rather than remain with the country. So you can't do a lot of deficit financing or a lot of poor accounting like Greece, Portugal, so on and so forth did. So I think it will mean more power to Brussels, but I do think that they will do whatever it takes to prevent a systemic crisis from taking place.
When you hear about the sound bites talking about fiscal cliff by the end of the year, that the presidential elections would be really a non-event, there'd be change of guard, but nothing really on the policy front. And then that, come 2013, the first 2 quarters will be negative growth for the U.S. How do you react? I mean, as an investor.
I say history is written by optimists, not by pessimists.
Okay.
So, I believe in economic growth. I believe in the probability of free markets solving the problem. I believe that when push comes to shove, democracy stands up and does what is right. We have political paralysis in New Delhi. We have political paralysis in Washington. And I know how people are bitterly fighting over each other. But when push comes to shove, democracy is the rule of the people, and the people force the politicians to make the right decisions.
All right, so here's a quick question. I mean, you look at the CAC, you look at DAX, the FTSE, you look at S&P 500 that you pointed out, the Dow Jones, they are all up year to date. You're looking at the euro, despite all the bad news, still holding 1.20. Can all of this reverse or change in the next 4 months?
Of course it can. Anything can happen in financial markets, Tanveer, as you're well aware. But I believe that come September 6th or 7th, I forget the exact date of Mr. Draghi's announcement, I think the market has taken cognizance. He's already said, and his words are, I think, go down in history, we'll do whatever it takes.
They could be far from reality.
I don't believe that. Okay. I don't think Mr.
Because that's been popular perception.
Shoots with empty chambers in his rifle. I think he's thought it through. He realizes that it's history calling. This is a crisis of the moment. He realizes what can happen if they don't deliver. I think good sense will prevail, and the global economy will not fall off a cliff.
All right, Ramesh, on that optimistic note, we'll take a short break. But when we come back, we will talk about specifically the Indian market and all the key local macro concerns that are influencing it. In a bit, don't go anywhere.
If the index doesn't make 21,000, which is the old high, for the next 6 months, year, 2 years, I couldn't care less as long as the market is rewarding good profits, good quality of earnings.
All right, welcome back to the special edition of ET Interview, and we're in conversation with veteran investor Ramesh Damani. Ramesh, let's talk about India's domestic micro and macro concerns.
How much
the
time do you
market.
have? It's a long story.
I know, it is a long story, and one that everybody's discussing all the time. The market is up. 14% plus year to date, despite all the bad news. So while we might be debating the macro concerns, the stock market has given positive returns, adjusting for the volatility.
Yes, that's what been a surprising feature of the market, that if you look beyond the bad headlines that repeatedly hit the pink papers every single morning, whether it was the rupee depreciating, whether it was the gridlock in parliament or any other thing that you will, the market is actually quietly built on a good solid gain for Indian investors.
Why do you think that's happening?
I think prices have gotten too cheap. I think in December we hit the panic lows in the market. And typically markets, once they factor in the bad news, you can't kill a person twice. You can't take the market down on the same set of bad news. Market, as you know, is a leading indicator, and it kind of factored all that in there. So my feeling is that even in unless situations get really out of hand, the lows that we saw in a lot of the cash stocks in December are not going to be revisited. What market will go through its regular period of rotation and correction. So something would dramatically have to go wrong from this period. Some global problem that I cannot anticipate at this point for the market to go back and revisit the lows that it made in December. But the more important point is that there are two markets in India, just like Charles Dickens said in his famous book, A Tale of Two Cities. The market is a tale of two stocks. I told you in the earlier segment that the market is rewarding total return. That is stock return plus dividend. All right? And that has been a global phenomenon. It's been true not only in America, it's been true in India too. You look at the great companies of India which have predictable dividends, great cash flow, and good corporate governance. They're all trading at 52-week highs. The preponderance in FMCG, cement, pharmaceutical. So, people who invest in those sectors actually are making money, not 13% as you said, that the aggregate market has made, but much more than that. I think some of the FMCG stocks have doubled in 12 months or 18 months period. Some of the pharmaceutical stocks are far higher than they were at the 2007 peak. Some of the cement stocks have gone up 8-10x from the lows. So, you're making a lot of money, and markets are always supposed to reward good stock picking. So what are we confused about here? If the index doesn't make 21,000, which was the old high, for the next 6 months, year, 2 years, I couldn't care less as long as the market is rewarding good profits, good quality of earnings, which the market is doing.
Right, but there's always this tendency to benchmark your returns against what the index is doing. Over the last 5 years since the crisis, we've seen the market give positive returns at the index level, barring, of course, 2008 and, last year. The fact remains that, you don't know whether these intermediate rallies are false rallies, or are we actually seeing a resumption of the bull market, something that was your view at the start of the year.
It's, I've also baffled on that, to be honest with you, so I won't take full credit for it. But it's hard to say. We know that only in hindsight, whether it was the beginning of a new bull market or just a bear market rally. Either the evidence is too early and too premature for us to come to any firm conclusion out there. The only point I'm making is that investors have been rewarded by buying good quality companies. If you bought companies with a lot of debt, with poor corporate governance issue, too much ambition in terms of expansion, those prices have been slaughtered. And as well market should do. Market will always respect superior capital allocation. And market has respected that, not only in India but globally.
Let's talk about the market's, obsession, so to speak, if I may use the word, with the GDP numbers. Most bearish view that GDP growth can slip below 5%. How much of that do you think is factored in?
I think the reason the market fell 25 to 30% from its peak, 50% one fall, but maybe 25 to 30%, is because market factored in GDP slowing down. I mean, it's horrible. I think as a country like India, we need to grow on a sustained basis over 7.5%. I mean, it's a moral imperative, and we need to push so many people out of poverty into middle class. You cannot do that 4%, 5% growth. It's okay for an American economy to grow at even 3%, but an economy like ours that is just, getting its foot out of the door, we've got so many people wanting to get into the middle class, we have to grow at 7.5%, 8%. I hope Mr. Chidambaram, I think he understands the problem. I hope he has the political capital to fix this problem. I think clearly there's a man who understands it. It is him. Does he have the political capital to fix it, before an election year? I'm not sure. Time will tell. But he's done some things easier. He made ECB borrowings easier, so people don't have to pay those high interest rates anymore. He's looking at GAR again. He scrapped the old DTC, which was his baby, basically, and coming out of the new DTC. So, I'm hopeful. I mean, that's, You're
hopeful, but what's your base case scenario of what GDP can be for FY13?
I'm not an economist in terms of I don't track the GDP number that closely, but, I'll take it that it'll be around 5.5%.
Okay, somewhere in the middle.
Yeah. So, I'm not expecting 7%.
If we did below 5?
It would be bad news. It would be horrible news.
Do you think sub 6% is a given? From the market's standpoint?
I think, yes. I think for this year, yeah, sub 6% is probably a given, yeah.
Okay. I also want to talk about, the floor for this market, which you have very vocally stated that 4,800 is the kind of base that you see. You think that's been revised higher? I mean, we went past 5,400, 5,600 was the 2012 high. Where do you think we are?
I hope so. I think the panic lows that we hit in December 2012, I remember I was overseas somewhere and I was getting these panic calls about cash prices falling every, single minute, if you will, out there. Those lows are unlikely to be revisited. I think that was the buying opportunity. Typically, market will then begin a pattern of higher highs and lower lows. Higher highs and higher lows, I'm sorry. So it will, trace out those patterns over a period of time, which is what I think we're doing. So I think, you'll probably say that 5,000 Nifty is now the base case scenario. No one knows this for sure, but that is the operative assumption that I'm going on.
By the end of this year, do you think we'll close closer to 5,600 or closer to 4,800?
Oh, guess 5,600.
Yeah, okay, that's the optimism you're talking. Ramesh, the currency view. How much is the risk of the currency going down from here? 56 roughly seems to be the base right now.
I hope so. I mean, I'm really a votary of a good rupee, not necessarily, a very, very strong rupee because, we for exports needed, but, it's horrible. I think we impoverished a whole generation by keeping the rupee. Like I said, it's the easy way out. I hope we find a home around 52, 53. Given the way we are handling our fiscal mess, maybe 56 we should be grateful for.
When do you see the economic cycle bottoming out and when do you see the market factoring that in or reflecting that?
I think a lot of bad news is baked into the price. In terms of inflation, now we're seeing inflation come off. In terms of the rupee, I think the rupee has depreciated its course. In terms of the fiscal deficit, I think nobody, even in New Delhi, wants us to go to junk status, so they'll do whatever it takes to prevent that. So I think a lot of the bad economic news is factored in there, and the news will get better from here on. Hence, the market has already reflected that.
All right, Ramesh, we'll talk about a specific investment philosophy in this kind of a market environment in just a bit. Stay tuned. We're still in conversation with Ramesh Damani.
My experience tells me that just because a stock seems overvalued on a matrix like PE is